Well, the way I read it was the Fed's going to raise rates 75 basis points. There's no question they're going to keep going. You're printing an inflation CPI number of over 8%. What no one knows, though, is how much of this inflation is caused by supply chain issues. Because, I've got a pretty good lens on supply chain issues. I have 54 private companies in our portfolio. Everything from gym equipment to greeting cards, commercial kitchens, wireless charging, you name it, we're involved. And when we talk to the CEOs of these companies, they're still having a really hard time. Let's just take the gym equipment company in Fargo, North Dakota. We used to get our metal from Asia. We can't get it anymore. We can't get it through the port in Los Angeles. We have to make the barbells and all the gym equipment in the US, cost 30% more. We pass the price on to the consumers. They're still buying it. And that's inflation. Now, as soon as we get the supply chain thing worked out, we'll be dropping prices, but we haven't been able to get it worked out yet. So I think half the inflation, frankly, from my point of view, is this temporary supply chain, but I don't know how temporary it's going to be. I've been waiting a year now to fix just the gym equipment story, and it hasn't been repaired yet. At what point do they indicate that they're going to stop? Because another 75 basis points already anticipated in the 2-year. You're 4.5% on 24-month money. The stock market is fibrillating. It's having a lot of volatility. The VIX is trying to figure out the moment the Fed pauses. And so this is the interesting challenge. I don't care if you're in crypto, your equities, or bonds. What happens in these cycles, and this is always a challenge, and we have a good example in recent times, 2020, in the middle of pandemic, total chaos around the world and the markets. The stock market actually did quite well because there was all this QE coming into it, this quantitative support and the Fed printing money. But all of the returns, 95% of the returns came in basically 18 trading sessions, 18 8-hour periods, where you had that volatility, 2,000 points up, 2,000 points down. You just didn't know which day those up days occurred. And so if you were trying to time the market, you missed the entire returns of the year. The same thing is going to happen here. As soon as people figure out or feel or just get the tone from the Fed that they're going to take that pause, you're going to have a violent swing up in the market. And if you're not in the market that day, that's half your returns you'll miss. It'll happen in a few days. And so, everybody tries to time the market. It's impossible. Everybody learns the hard way. I did years ago. So I stay the course. I try and add a little bit on down days into just an index. I use a broad index of both mid cap and large cap stocks that Alps put out, and shameless in telling, it's OUSA and OUSM. But those indexes are 300 really high quality stocks in the US that pay dividends. And they're violently volatile, except yesterday was crazy up. So I'm glad I was in the market yesterday. Same thing could happen today. You just don't know. Timing is impossible, and this volatility makes everybody squeamish.